As we kick off earnings season, a look at the overall major markets and where might be the best place to place your bets. That's coming up on 3 Minutes on Markets and Money. As earnings season kicks off, over the next couple of weeks, we're going to get a deluge of earnings, primarily from the major cap companies. But I wanted to take a look at not just the S&P and where we're currently trading, but also some of these other major markets. Because again, as we are trying to look to where to allocate capital, we don't want to miss out on a potential rotation between markets. Starting with the S&P 500, as we've noted in the last couple of days, market did rally back above the 50-day moving average. That's good. We're oversold, turning up on a buy signal here potentially. That sets the S&P up to rally back to these previous highs that we had earlier in the month. I don't really expect much more than that. We're going to be about 2 standard deviations above the moving average at that level. Could go a little higher from here, but because the Fed is now about to start hiking rates and reducing their balance sheet, we're likely to see some continued pressure on equity prices, at least for the next month or so. Let's jump over to the NASDAQ. As opposed to the S&P, the NASDAQ not performing quite as well. Again, NASDAQ is oversold like the S&P. We are starting to turn up on a potential buy signal for the NASDAQ as well. But the NASDAQ still trading below the 50-day moving average. Again, today's action may push us up above that level. But again, technology stocks, and particularly the mega cap tech stocks, Apple, Facebook, Microsoft, have been under a bit more pressure here as of late. A lot of those stocks are down between 5 and 6% for the month, and that's been putting some additional pressure on the NASDAQ. But again, if we can get a lift to the S&P and the overall markets, that's going to drag up the NASDAQ as well. And if we begin to see some disinflationary pressures in the economy, that's going to start to lead back to a rotation towards growth stocks as well, which tend to do better in a disinflationary environment. So there is a potential here we can see some better performance from the NASDAQ and those technology-related stocks over the course of this summer. Small cap stocks, of course, are the most impacted by slower economic growth, higher interest rates, economic contraction, inflation. And as such, small caps have really not been performing that well, have been really underperforming the large cap indexes like the S&P and the NASDAQ. But small cap stocks recently over the last couple of days have been performing better on a buy signal about halfway through its rotation from oversold back to overbought. There is upside to about $95 on the small cap index. But again, the long-term trend in small cap stocks has not been favorable. Again, a potential trade here for small caps in the short term, but on a longer term bet with higher inflation, slower economic growth, that's going to impact their earnings. And I would expect to continue to see, as we get into a later economic stage cycle here, that small caps will begin to underperform. The same actually goes for mid caps as well. Not surprisingly, mid caps look almost identical to the small cap index. A lot of underperformance relative to the S&P and the NASDAQ. Again, on a buy signal, moving through its oversold to overbought condition. Again, some upside here on the mid cap index to about 502, previous top here that we saw at the beginning of the month. But long-term underperformance still likely. Again, same as small caps. Mid-cap companies are affected more by inflationary pressures and that ability to pass on costs. They have an inability to do a lot of stock buybacks to support asset prices, and slower economic growth will impede their earnings on a relative basis more so than what we see in large cap stocks. Lastly, let's just talk about emerging markets. Emerging markets just continue to be under a lot of pressure. Slower global economic growth, higher inflation rates, the war in the Ukraine, all these areas still weighing on emerging markets. They've been a big underperformer this year, and really over the course of the last decade, emerging markets have been underperforming large cap domestic indexes. Currently still on a sell signal. They are oversold right now. Could see a bounce here. But again, as we've been stating for a long time now, I would probably use any type of bounce in emerging markets to reduce that exposure and shift that exposure into domestic exposure, at least for the time being, particularly with the dollar rallying strongly in the U.S. That's 3 minutes on markets and money and a quick major market overview. I'm your host, Lance Roberts. We'll see you next time.